This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel. And after, that manic Wednesday that we had, some signs of stability in the market. A lot of the cues are now out of the way. So maybe it's back to routine business. You never know, but long day ahead.
Well, let's see whether the bulls have more firepower to build on yesterday's gains.
Yes.
So let's get straight to the action.
Absolutely. And I think the action overnight is not all that great. And I'll get to that in just a bit. But yesterday was good, right? Because there was finally relief. A relief after many days of, pressure. Actually, everything happens double quick time, right? Earlier, it used to be months in the making, a correction, a distribution pattern. I mean, here we have a 14% fall on the small cap index, which basically took about a week and a half or so, a little more than that, a fortnight or so. The bulk of that 14% came in that period. But yesterday we saw relief, a sharp rebound. The small cap index bounced 3%, and that's essentially, the relief I'm talking about. The Nifty was up 140, 150 points. But that is not where really the big pressure was. The pressure was in the broader market, and there we got a decent bounce. PSUs, which had all been bashed up, etc., they also came back into the mix. Now, before I get to what to do and the setup from here, just a quick word on the US market because it's a little pronounced. You got the S&P, which was down a third, NASDAQ, which is down about a third of a percent. But the big thing is the rally in US yields. The 10-year on the US bond curve is up 10 basis points. Yields are up 10 basis points, and we are back at almost about 4.3%. And consequently, you've also got strength in the dollar, which went up 0.6% to about 103.4 or so. So yields are higher, dollar is up, and of course, equities are lower as well. So what is the trigger? US PPI numbers, which is producer price index numbers, came in stronger. And at the same time, you had weekly jobless claims, which fell. So it's basically strength in inflation, strength in the labor market, which is what these two data points are showing. At the same time, you had retail sales, which came in weaker, and that's basically pointing to a slower consumption. I mean, it's just three sets of data point, but both pulling in the opposite directions and in the unwanted direction, right? Strong labor market, inflation not cooling off, but consumption starting to slow off. And that's what I think markets took notice of. The March FOMC, I think, is what markets are very focused on. No changes expected, no cuts, of course. But are there any hawkish risks? Will the dot plot, etc., could there be some changes there based on the recent strengthened labor market that we've seen? So a little worry there. Oil prices, that's the other leg, right, which has also moved in the other direction. It's up back above $85 a barrel, was about a 1% move. I think for the week, Friday to Friday, we've seen a decent 4-5% kind of a move as far as oil is concerned. Now, just to come back and circle back to levels here, Nifty held the 40-day exponential moving average and rebounded sharply. That's point number one. Next few days will tell us if there is more pressure ahead. The point is, after a sharp correction, especially in the broader market, it'll take a little bit of time to settle. A point we made yesterday as well. Rallies will come, and at higher levels, I mean, whoever is basically a little underfunded in terms of positions, I mean, leveraged positions, those people will try and come and sell at high levels. So there will be a little bit of selling which will emerge as the market tries to make its way up. So, rise, a little bit of selling, back down again, rise, selling. So it'll take time for this sort of pattern to play out as it usually does. For the Nifty, the near-term resistance is at the 20-day moving average. That is very close by. We are at 21,150. This is at 22,217. But that's a very near term since we're talking about the Nifty. Bank Nifty ended in the red today, closed around 46,700, which is, by the way, the 40-day exponential moving average. There is a downward sloping trend line. That support comes in at 46,520. It's about 200 points away from where we are, where we left off yesterday. And if that breaks on a closing basis, the trend line support, then you're talking about lower levels, like, for example, the low of 44,429. On the way up, short-term resistance for the Nifty Bank comes in at about 47,200. I'm sort of, only the supports and resistance have been placed only within 0.75%, 1% from where these indices have left off yesterday, because that is the kind of market we find ourselves in. The GIFT Nifty will come up on your screen, which will give you a sense of where the open is. It's straight away, it's showing at least right now 100 points. And I think there is an element of course, the global stuff as well, which is working in the, I don't want to say wrong direction, but in the direction we don't want it to work in. Sonia.
Absolutely. I think the big question is, after yesterday's pullback, a little bit of a pullback, are we headed for some more stability in the market, right, in the next few days, including today? So let's look at a couple of things. One is the Nifty held on to the 22,140 mark yesterday. So that was a good thing. There was some signs of stability after a manic Wednesday, and that's pretty much what the market would want to see. A couple of days of just no sell-off in the market, and that would give some encouragement to the bulls. A lot of the near-term concerns, though, have been addressed, whether it's the electoral bonds, whether it's the stress test for mutual funds, whether it is the fuel price cut, the advance tax payment. All of these triggers are now out of the way for the market, which means that the market can get back to routine course of business. There are a couple of things to watch out for. There's the FTSE rebalancing that takes place today. There is the election code of conduct that is expected very soon. So these are a couple of big triggers to watch. Also, in the US, the inflation report was hot. So that is something that has spooked investors a little bit. You saw the US markets under pressure. So maybe that could drag down the overall markets in the morning. The Fed fund futures is now pricing in a 99% chance of the Fed keeping interest rates unchanged in the next policy. There's no movement on rates that's expected in the next policy from the Fed. But a couple of data points that I'm watching out for. There's the consumer sentiment data, there's the import prices data, there's the industrial production data from the US markets. But for our own markets, I won't be surprised if there is intraday volatility for sure, given that we have weak global cues, as well as, the Nifty implied opening is under pressure. But the important bit is, after that big sell-off that we saw on Wednesday, yesterday some stability returned. So maybe, the market is attempting a recovery.
Well, that's right, Sonia. Actually this morning, the problem is the troika is not in our favor. Whether you're looking at the 10-year yields, whether you're looking at the dollar index, or even Brent crude prices, all three of those factors are not in our favor. But for the highlights of the day, well, yesterday we went ahead, we defended the 50 DMA, but the 20 DMA remained elusive. The next part is that, the FIs, they added shots on index futures. And does the broader market have enough in it to build on to yesterday's gains? Because clearly yesterday, that was the most beautiful spot of the market. The number of stocks advancing in comparison to the number of stocks declining, well, that was in the ratio of close to 5 stocks in comparison to one stock that was declining, which was a big U-turn from the previous trading session as well. So good going on that front. What did the FIs do? Well, they added close to 11,000 short contracts. Second day running, they added close to 11,000 short contracts. And yesterday, they added 2 shorts for every 1 long position. And that's what takes the short positioning in the last 2 days from around 30,000 contracts. Now they're net short at close to around 50,000 contracts. I like a market where the FIs are net short. As I always say, it gives you a reason to believe that could be a short covering bounce at some point of time. But a market devoid of any kind of shorts, well, that's a bit of an issue as well. Let's run you through then the options data. And the big trigger yesterday, and the reason that I said there could be an intraday bounce, was because the PCR came to around 0.65 odd. So the call writers were feeling too happy and too comfortable. They got complacent actually. And now that PCR has moved to around 1.1 approximately. So that trigger is out of the way. There appears there's a bit of a strategy at this strike, 22,200 call as well as put. So a short straddle is what we call it. Pocketing close to 300, 350 rupees odd and bracing for that broad range of around 600 to around 700 points. On the downside, 21,850. On the upside, 22,550. So let's get the levels up for you on the screen. Yesterday, the day's high as well as the 20 DMA, they're almost in line. So the 20 DMA seems to be a bit of a resistance on the upside. On the downside though, the 50 DMA, that's a crucial support because we went there yesterday and from there we did bounce. So the 50 and the 20 DMA, that's the 2 markers you're looking at on the Nifty. On the Nifty Bank as well, we are pat in the middle of the 50 as well as the 20 DMA. Yesterday, we bounced off the 50 DMA, but we couldn't conquer the 20 DMA on a closing basis. So I'll be looking at that level very, very closely. So for starters, we start off in the red. Let's see if that intraday dip gets bought into. But the line in the sand is the 50 DMA on the downside. On the upside, the 20 DMA. But more than the indices, the broader markets is something that you'll be focusing on very closely.
No, absolutely, Nigel, and we'll keep an eye out on some of this stuff as you highlighted. But let's go across to our first discussion here on the program. Sandeep Tandon is founder and chief investment officer at Quant Mutual Fund. He's joining us early on. Sandeep, good morning. Great to see you in the morning on the program here at CNBC-TV18. Appreciate your time. And congratulations, you were first off the block in releasing the results of the sort of stress test for the mid-cap and small-cap parts of your portfolio. So we got the numbers and we'll put the graphics up, etc. The way the data has been provided, the sort of crucial kind of operative part, which everyone is focused on, is how many days will it take for funds to liquidate 25% of the portfolio and then 50% of the portfolio, right? And the simplistic way it's being kind of implemented is the lower the number of days, the better. Lesser riskier because the portfolio is more liquid. So just talk to us about what you've done in terms of the presentation you've put out, and of course the explanation as well. Is that the right way to look at it? Go on.
So Prashant, we have not done any major changes because this announcement came in the Feb end, and the data which we have to provide also has to be on the Feb end. What we have to look at is that, at Quant Mutual Fund, our both small and mid, our portfolio are fairly liquid. Okay, if you really look at for last 1.5 years, okay, right from September 2021, when we talked about that there's a euphoric phase globally which has peaked out, the easy bull run has peaked out. So we talked about how we have moved gradually towards a large cap also. So we are nearly 30%, 28 to 30% is the number where we have large cap stock also in our mid and small cap portfolio. It's a part of our strategy, how we manage money in a dynamic way based on the environment which is changing, whether risk on or risk off, or aggressive risk on or aggressive risk off. So we are trying to do. If you really look at what regulator is also trying to convey, they're not putting any restrictions. Basically they are trying to ask AMC that you should look at, even you should ask your investor what is their risk appetite, what is their investment horizon after mid and small which has rallied. Okay, and they're talking about disclosing more data points. Okay, basically talking about what is the risk level of your portfolio, what is the liquidity level of portfolio, so that investors should aware of, okay, when they're participating or they're increasing the exposure in mid and small cap, or whether they like to switch to other schemes or they want to hold the scheme. So it's a part of a more transparency regulator is asking, and we are trying to give that data. So it's a step in the right direction. In fact, if you really look at lot of data points, we actually have started giving in our annual monthly fact sheets also. Okay, so a lot of risk related measures we already provide in our monthly fact sheet, so that not only for these two schemes, but we provide actually for all the schemes which we manage. So it is a more of a transparency with the investor. They should understand their the scheme risk profile, the liquidity aspect, and how the performance has been from a risk adjusted point of view.
Yeah, no, that's well put. So that's a good explanation. Sandeep, you are putting out the data for your fund, but we've also got data from others, Edelweiss, Aditya Birla, Sundaram, Motilal, Axis, and we'll get more as the day goes on. But you're a fund manager as well. You're an active hands-on fund manager as well. And this was something which market participants were waiting for, this data. Is there any takeaway looking at the disclosure so far for you, or will you take away anything when you look at these portfolios?
The only thing which I like to take, it is a step in right direction in terms of more transparency and more disclosure. Okay, I don't think I will like to read beyond that, because there is no classic signs of euphoria which has happened in the Indian equities. And multiple times I've said that that global euphoria we saw 2021, particularly in the growth stock or technology stock or fintech. But if you really look at from the current level, when I don't look at, yes, there could be hype in many sectors or maybe certain pockets. There could be hype, but that is a part of a market. As a risk manager, we do have to rebalance and reconstruct our portfolio. That's what is we do it anyway dynamically. When we see some hype getting built, we prune down exposure and look for new opportunity, new sector, new stock. That's a part of any money manager. We have to do that. But if you really look at, if market is worried about that we have seen extraordinary hype got built or extraordinary euphoria, so I will tell you purely from a predictive analytics point of view, I have been very vocal. We are not seeing any classic signs of euphoria. You leave apart few pockets, but if I look at the broader market, which is not, let's understand, when you look at this data, I always talk about in unidirectional, purely on the valuation, you might feel that they are stretched? Answer is yes. But if you really look at some of the data which NC, we have taken from the NSE or the Bloomberg data, if you look at the P multiple also, though it's not the right way of looking the real valuation, it's just one of the data points which we talk about. Yes, small caps is particularly 250 index is marginally higher than the what was there in the COVID lows. But if you really look at the mid cap itself, they're very, very close to pre-COVID lows. It's not like that there also it is stretched. Yes, it can be expensive, but I don't agree with those. The P multiples are significantly stretched as compared to what happened in 2018 or what happened in the post-COVID scenario also. So that is the one aspect we have to understand.
Okay.
They are expensive, but they are not stretched. And similarly, you also have to look at what is the liquidity situation. Liquidity situation, particularly the good liquidity with the way we define, more from a macro data point for India is very, very conducive. Actually, is month on month, right from last many months is actually increasing. Okay. And the good news is that from October, November, the India risk appetite, okay, as a country, our risk appetite has actually moved up. So it's a very constructive background for Indian equity.
Got it.
That's what we are trying to say. It's opportunity sometimes. Yes, obviously you have to assess your risk profiling. You have to assess your investment horizon, because a lot of
Got it.
people buy from long-term perspective and market corrects. Their horizon changes overnight. So those are the aspects you have to, and this is what regulator is asking, that you reassess.
So got it. Sandeep, hi, this is Sonia here. Good morning and thanks for joining us. So you said that the stress test only helps increase transparency in the entire sector, and you're not too worried about the PE multiples at the moment. They are a bit stretched, but there's no euphoria that is set into the market just yet. Got that. I want to ask you a little bit about the redemption situation. What has it been like from the retail end in the last 2 weeks? Because people are genuinely concerned about the kind of erosion that they've seen in their portfolio. Have you seen any major signs of redemptions?
At least at our end, we have not seen anything dramatic, which you can say the inflation. In fact, our flow has been remained as it is. But yes, sometime when market correct, a lot of people who are weak player, whether in the mutual fund side or in the market, they tend to get capitulated. Okay. So and this time, if you really look at, I always have been talking about that Indian retail investor has become much more mature. Okay. And when I say maturity level, they don't get carried away so easily. They don't get capitulated. So I have seen a trend. If I look at last 3 years, particularly from post-COVID, okay, when we have seen how the behavior pattern of real retail investor has changed. Whenever there's a crisis, market correct sharply. Actually, at our end, we have seen the flow actually increases significantly. And when market rallies, they tend to book profits. The problem is not with the real retail. The problem is more from the family offices side, ultra HNI side, who also run a lot of leverage positions, extraordinary exposure in the equity side. I think those are the people who are getting more capitulated this time, and they have made tons of money. Their exposure has increased significantly. I think panic is there in certain pockets, more from this particular category which we are referring, because these are the people who have participated in the SMEs, they have participated in the private equity side, they have participated in all possible instruments in the market. When you are obviously made extraordinary money and the market correct, then it's a panic situation out there. But from a real retail point of view, I don't see whatever data which we look at on daily basis, we don't see any situation of panic.
Okay, got it. That's good to hear that the panic is where people have taken more leverage, maybe, in the SME space, etc. But at the retail end, not too much. Got that. One more question from my end on PSUs, because this is a space that you've been very bullish on for a while across the board, right? And it's done very well. At this point in time, what is your view?
So I think the way we look at PSUs also, we have been talking about value as a thesis. Okay? And PSU, overall PSU, not only PSU banks, are part of a value thesis. And we right from September, October 2021, we saying this decade belongs to value. And we are one of the few houses who has written in 2019 about that Japan will be the biggest comeback story, and Japan by 2023 will make all-time high, which happened. And you look at Japan is a value market. Okay, well, that's the reason I'm referring. Japan is one of the biggest value market. Like US people consider as a growth market, Japan is a value market. And a lot of limited people could have ever visualized that Japan will make all-time high or what happened after 80s. So what we are trying to look at the market is that don't look at just PSU as a PSU theme. It's a larger basket of a value thesis which is playing, and PSU is part of that. And then if you come to within PSU also, I've been very vocal about it. Something has changed, okay? Both from the governance point of view, capital allocation point of view, and the perception about the Indian PSU in particular, where a lot of money managers used to say this is untouchable, this is something I will not touch. But the way I look at something has changed and something will change further. So these sector, particularly all PSU, I'm not talking about one or two individual names or illiquid names in PSU which have rallied significantly. Obviously, they will need to correct and they will correct further. But from a larger cap perspective, I think we remain very constructive. If I talk about quant perception analytics for the PSU, I think is only increasing month on month. So we are very constructive. But from a medium to longer term perspective, I'm not talking about just from a very short term or near term perspective. Somebody has a longer term horizon. I think that's an area which I would like to remain invested.
All right. Hi, Sandeep. Good morning and good to hear your thoughts on PSUs. We'd like to know more about that. But I want to talk about one of those darlings of the market, which have been quite disastrous in the last few days, Swan Energy. You all were early in there. I think you all got in at around 300 rupees or thereabouts. And then you all participated in the QIP as well. But that stock has taken a hard knock from the top. I wanted your clarification on this. Have you all been sellers? Are you all still?
Nigel,
what is the outlook on this one?
Yeah. Generally, we don't comment from a compliance perspective on individual stocks. But I will talk about infra has been we have been very bullish on India infrastructure story. We still like it. And if you ask me if I break the from a noise perspective, that's a different issue. But if I talk about capital good versus broader infra, I think the capital good stocks are peaking out. They are extraordinary, euphoric right now. Their P multiples are very much stretched. But if I have to talk about larger construction space or larger infra space, okay, and whether you talk about even the utility companies or the infra names or the equipment providers, I think India is growing so sharply. Okay, then these are the names which we do very well. And this is part of now talking about defense opportunity. So it's a combination which we look at, as an institution player, we don't get paranoid with 1 or 2 days fall, because if somebody has built leverage exposure, okay, they tend to get capitulated. And this what happened is not only about particular one company, the entire market, okay. Even the best of the names corrected 8, 10, 12%, okay. I'm talking about not the penny stocks. It's the large cap companies were down 8, 10% yesterday or day before yesterday. So you have to look at, as an institution, we have taken a conscious call. It's a 2-3 years perspective, which we are very bullish. So we like to remain invested in some of these names and look for more opportunity in the sector where we are bullish.
Yeah. Sandeep, last time we spoke, and just to go back to that PSU thing, right? You said, and your idea was larger PSUs. Your Coal India, your ONGC, LIC. These were some of the names that we discussed, without specific recommendations per se. So should one take to understand, that's a space broadly, the larger top-tier PSUs across sectors, where you focused on and remain very bullish?
Yes, we have participated. If you really look at in last, right from I said some September, October 2020. First, we played out PSU banks as a thesis. Okay, we were the first to get this out there, and we actually made good amount of money. Over a period of last few quarters or few months, we have pruned down PSU bank exposure in overall portfolio, except one name. The entire portfolio we have moved on, but we have moved towards other stocks. Okay. So as what we discussed, the larger PSU, not necessarily bank, See, when you look at, Prashant, when we look at our analytic framework, we do look at in terms of which are the stocks which are traded in the neglected zone and which move to the admired zone. So it's a natural phenomena. All the stocks which move to admired territory, we tend to prune down, and the stocks which are in the neglected zone, we tend to add. This is what we do. So we felt many PSU banks moved to the admired territory, not over admired territory, but they were in admired territory. And hence we pruned down, and some of the names which mentioned, they were still traded in the neglected, despite being the more liquid names, very large market cap companies. So they have obviously become the obvious choice. If you really look at in our portfolio in last many months, what we are trying to see, we were very early to move out a very substantial portion of our portfolio within mid and small cap basket towards large cap, more from a liquidity perspective. And even some of these names, we actually generated massive alpha for our investor. So it's our perspective when we see any signs of any changes in terms of data analytics, when we try to rebalance our portfolio. Today, our portfolio, in fact, when the stress test came out, our portfolio is very liquid. In fact, what regulator has asked about the stress test, it is based on certain assumptions which they have given. So these stress tests are actually very conservative. Okay, but in real life, like, yeah.
Yeah. No, I got that. Just one quick point, some have pointed this out, that in terms of so for example, day before yesterday was an extraordinary day. I mean, there was the index itself fell about 5%. Mutual fund NAVs, not just for you, but others as well, fell sharply. I mean, 4-5% in some cases in a single day. Now, that's a sharp hit. And because we've not had a significant correction for a while, I mean, sort of it in that way hit harder. Is there any change you would sort of effect as a money manager in the style, or not really, given what we saw, that what can happen? I mean, you've seen this in the past, but none of us have seen this in the recent past. We're kind of used to a very trending higher market. Go on.
But if you, Prashant, if you really look at the bull run, let's say the bull run which started from April 2020, okay, and until now, nearly 4 years has passed. And n number of times, at least I can say on multiple occasions, maybe 5-6 occasions, we have seen a very sharp fall in the market. And you also have to keep in mind that March is the phenomena which even last year, March also, February, March market corrected very sharply. Because it's a year-end phenomena, a lot of people unwind their position, a lot of corporates don't want to show the exposure in the equity street. So it's a phenomenon, a lot of people just unwind their trades by the year-end, okay? And so it's a more of a year-end phenomena which market was talking about, we do understand. Then over and above, market was slightly stretched, we have seen right from October till February, massive rally. So when market was slightly stretched, slightly overbought, when I say stretched from an overbought perspective, one vertical move you saw. So obviously correction was due, okay, and when correction happens with various reasons, okay, 2-3 events which triggered suddenly this fall. So I think the narrative was something got changed from a very near-term perspective. But if I have to look at the reality of the Indian macro story, I think we remain very constructive. Okay, if you really look at in last 4 years, n number of times we have seen 10%, 15%, 20% correction also is not happening just for the first time. Now it's up to us whether you want to get capitulated and give up and move out, or if you believe India's story, which we believe, I will look for a buying opportunity. It's a classic capitulation which happened. In fact, a month back, some of these small cap and mid caps also were looking very stretched in terms of valuation aspect, which we talked about. But again, many names becomes very attractive. So what we have to look at in this environment, liquidity is very important. So you have to buy the more liquid names rather than buying the illiquid names going forward.
Okay, Sandeep, thanks a lot for your time this morning and appreciate your thoughts as well. That is Quant Mutual Fund saying that the stress tests and additional disclosures are a step in the right direction and it will help increase transparency, and there's no dramatic signs of redemption coming in from retail just yet. Let's slip into a quick break. On the other side of the break, we have our entire research team to help us with a list of top 10 stocks as we begin a brand new day of trade. Welcome back to Bazaar Morning Call. Well, this morning, lots of individual stocks in focus and our research team is standing by. First up, there's a major development that has happened in the oil marketing companies. Sapna is joining in to give us the latest on that. Sapna, good morning.
Hi, morning. So on expected lines, though, of course, if you keep in mind, what the Petroleum Ministry had indicated over Saturday, when all these queries had been asked as to the possibility of a petrol diesel price cut, it was likely to be on expected lines because LPG price had reduced, the CV players had reduced CNG to an extent. So it was, inevitable that at some point in time, before the elections, before the model code of conduct, the government had to take a call on fuel prices. Plus, let's look at how the OMCs have been performing. Their bottom lines have been extremely strong. So this had been, to an extent, I would say, building up. Now, what we have been given to understand is that, despite crude at higher levels, I think the average as far as the Indian basket is concerned, it comes out to around $83 for the current month. And the indications always had been, that it has to be below 80 or somewhere around $75 odd. a barrel for the government, or rather, the OMCs will take a call on a price cut. But, going against that, this has happened, and it's a very calibrated and prudent price cut. This is what we have been given to understand from industry players themselves. And, fairly well distributed in the sense that CG players have reduced CNG price. The government has also taken care of the Ujjwala subsidy, has given benefit of 100 more rupees as far as the LPG subsidy is concerned. And prior to that, companies had also, reduced LPG prices. So what they're just trying to say is that it's not a big price hike done in one shot, which can impact bottom lines negatively. This is what is being told right now. Plus, they're also indicating just another 15 odd days to go for at least the current quarter to get over. So I think what they're trying to say is that these cuts are unlikely to impact the bottom lines of OMC. I think that is what is being indicated. Of course, the rest we'll have to wait and watch and see how crude prices pan out. If they go on the higher side, then we could see some impact. But, at the moment, that is negligible. And if you look at the prices of both the products city-wise, at least as far as petrol is concerned, in many of the cities, apart from Delhi, they're still very high, above 100 rupees, because mainly the state VATs are high. So also take action. Yeah, that will continue to be above 100.
Got it, Sapna. Appreciate you joining in and giving us a quick update on that piece of news. Well, let's hop across to Ritu. She's joining in to help us keep pace with the news flow on Paytm and Yes Bank. Morning, Ritu.
Morning, Nigel. So NPCI has granted 197 Communications, which is the parent entity for Paytm, approval to participate in UPI as a third-party payment application provider, which is TPAP, under a multi-bank model. Now, essentially, that is going to allow Paytm customers to continue using that app for UPI payments. And there are 4 banks that have come on board as payment service providers, which is Axis Bank, Yes Bank, HDFC Bank and SBI. These 4 banks are going to handle the UPI volumes between them. Now, separately, NPCI has also said that Yes Bank is going to be acting as the merchant acquiring bank for both existing and new UPI merchants for 197. Now, remember on a con call earlier, Paytm had indicated that about 20% of its total 4 crore merchants have accounts that are only with Paytm Payment Bank. So these will have to get shifted to Yes Bank, and any new merchants that Paytm acquires, which would be offline as of now because they don't have the online payment aggregator license yet, that will also have their bank accounts linked with Yes Bank. So in a way, Yes Bank is one of the key beneficiaries from RBI's action against Paytm Payment Bank. They get access to these customers, and of course, they can then cross-sell many other financial products to them. Even for these 4 other payment service provider banks, they're going to earn a fee for facilitating the merchant settlements for Paytm, and of course, they'll get access to float, which can be deployed for additional income. For Paytm, of course, some churn is expected in the merchant and customer base, and customer retention is going to be very key to watch out for going ahead. The March 15 deadline is also today for Paytm Payment Bank to wind down banking activities, and we understand RBI is unlikely to change the stance on restrictions, so we'll keep an eye on that as well.
All right, Ritu, thanks very much, and we'll keep coming back to you for more on this story. That's Ritu reporting on Paytm. Now, Vamakshi is joining in on Eris, Railtel and Ashok Leyland. What's the news flow here? Vamakshi, morning.
Well, good morning, Prashant. Let me first start off with Eris Life Sciences. Yesterday, during market hours, we did see an announcement come through that Eris Life Sciences will be acquiring Biocon Biologics formulation business for 1,242 odd crores. But apart from that, there was another announcement that came through wherein Eris Life Sciences announced that they will be acquiring an additional 19% equity stake in Swiss Parenterals for almost 237.5 crores. Now, they also held a con call on this development, and they have highlighted that they are quite bullish on the insulin glargine market in India, but there are some analysts that have expressed some concern around the human insulin business growth. They are also expecting the company to push their EBITDA from 70 crores currently to 100 crores, and in fact on the debt front, the company said that they will be focusing on debt reduction. They will try to bring it down to lower than 2 times of 1 year forward EBITDA by FY25. So on the back of this development, expect Eris Life Sciences to open in the green. But apart from that, Realtel will also open high higher today after the company has received work orders from Odisha Computer Application Center amounting to 114 crores. And lastly, let's also focus on Ashok Leyland. Expect the stock to open in the green after Creodor has announced that they will be investing nearly $50 million for 19.5% stake in Hinduja Tech, which is the wholly owned subsidiary for Ashok Leyland. Not just that, this values Hinduja Tech at almost $255 million, which is nearly 2,115 crores. And this investment will allow Hinduja Tech to accelerate its global growth plans. On the back of that, Ashok Leyland expected to open in the green as well.
Okay, thanks a lot for that. Well, let's go across to Upasna now for some other stocks that are in the news this morning. Upasna, good morning.
Good morning, Sonia. First up, NCC, the company's subsidiary, has reached a settlement with TAQA, India Power Ventures and Himachal Sorang. The settlement arbitration is mainly with a staggered payment of almost 175 crores versus 140 crores provided earlier. Next up is NHPC. GUVNL, that is Gujarat Urja Vikas Nigam Limited, has issued a letter of intent to NHPC for 200 megawatt capacity solar power project, and the estimated cost of this is around 847 crores is what the company has indicated. That's the reason the stock will remain in focus today, and I expect it to open in green. Next up is JSW Energy. The company has also received letter of intent from Gujarat Urja Vikas Nigam for almost 300 megawatt solar capacity. And with this awarded capacity, the company says that its total locked-in generation capacity increases to 12 gigawatts, out of which 2.4 gigawatts will be solar. Next up is Sundaram Clayton. Well, the MD and CEO of the company, Venu Srinivasan, has sold almost 7% stake in the company at 1,240 per share via block deal. That's the reason even this stock will remain in focus today.
Okay, all right, Upasana, thanks a lot for that. Well, let's do a quick recap of all the top stocks we just covered for you. The ones with positive news flow include Paytm, Yes Bank, NHPC, JSW Energy, Eris Life Sciences, you have RailTel, as well as Ashok Leyland. Well, stocks with negative news flow are OMCs, NCC, and Sundaram Clayton. Well, time to slip into a short break. When you come back, we'll get some fundamental analysis going. Siddharth Khemka, Head Retail Research at Motilal Oswal Financial Services, will be joining in. Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. Well, we have told you about global setup. We told you how trade setup. We also listed the stocks. Now let's get in some fundamental analysis. Siddharth Khemka, the Head Retail Research at Motilal Oswal Financial Services, joins in. Hi, Sid. Morning. Hope you're having a good Friday morning. Well, plenty of stocks to discuss, right? Let's talk about Paytm. You know, you have some positive news flow that we saw overnight. What's your view on the stock?
Yeah, very good morning, Nigel, and happy Friday to be in, especially after the recovery that we saw in the markets. Else, we would have been going into a Friday with a somber note, but leaving that apart. So yes, Paytm finally managed to get that NCPI approval for being a service provider, standalone service provider for the UPI payments. So that is positive, definitely coming in the last day, 15th, which was the deadline extended deadline set by RBI. So it's a positive news. Now the company has to focus over the next 2 quarters in setting up the operational setup, transforming from a bank-backed payments gateway to an independent payments gateway. We already know that now they have got 4 banks banking them. They have already seen a lot of churn in terms of merchants, users, 15-20% have already moved away. So those things will be the focus of the management in the near term. But I think somewhere this news was kind of a little bit factored in. So we definitely will see a positive reaction to this news today in Paytm. But as I said, the crucial thing would be for the company to stabilize the remaining businesses over the next 2 quarters. Stock price has reacted very sharply to the developments in the last few months, and I think at these levels, if things starts improving, definitely it should be positive going forward for Paytm. At this moment, we still have a kind of a neutral rating. We will kind of put it in the watch list to see how things improve over the next 2 quarters to have you can say concrete view on the stock.
Got it. Okay, so this is positive news flow coming through, but you'd want to wait a bit to see some more concrete positive news before taking a call. The other thing is the fuel price cut, right? OMCs could be under pressure today. The government has cut petrol and diesel prices by 2 rupees a litre. Some brokerages are saying that although this is a sentiment negative for them, the long-term view on OMCs is positive. How are you approaching this space now?
Yeah, Sonia, good morning. So I think there's a mixed view coming in with the 2 rupees cut. So a lot of street was expecting about 5 rupees or higher than the 2 rupees. So it's definitely a relief in that sense. But a 2 rupees cut would impact the marketing margins currently about 5.5 rupees. What we had factored in was about 3.5 to 3.8 rupees per litre. For the petrol, but diesel, I think it will go down and it will be remaining at the break-even point. The key question here is, will this price cut be for 1 quarter? Then the impact will be much lesser. But if it continues for a longer period, I think then FY25 numbers will definitely get a hit, especially for someone like an HPCL, which has the largest marketing network and the business, followed by BPCL. IOC, which has a much larger refining business, is the least impacted among them. Overall, as I said, the other risk that is there in the current environment is the crude oil prices, which are inching up because what is happening in the Red Sea, what is happening with the US, China. I think that is a bigger risk. If that continues to remain elevated, then the marketing margins could really come under pressure and the view changes for the OMCs. But I think overall, as you said rightly, yes, we definitely have a positive long-term view on the oil marketing companies. Any sharp correction on back of this news would be an opportunity for the long-term investors to pick up stocks. So while we like Indian Oil followed by HPCL, I think these are some of the oil marketing companies that one can look at. But in this current scenario, if oil prices continues to remain high and the price cut, I think in the near term, if someone is looking at the overall oil and gas space, I think we would prefer a GAIL in the current environment from a short-term perspective as well as from a long-term, but opportunities in correction to add to the oil marketing companies.
All right. Sid, just coming back to you, but I just want to address the story as well. The ICICI Securities delisting, right? I mean, there has been a lot of back and forth, a lot of debate around this one, but what's the latest? Vivek is standing by to tell us that. Vivek, morning.
Well, good morning. That's right. So, the company in focus is ICICI Securities. Remember, the proposed delisting of the company back into ICICI Bank. The board meeting is scheduled on March 27th. And like you mentioned, there's been quite a bit of to and fro. Retail, a lot of retail investors have been up in arms against this particular demerger, saying that, the rationale as well as the valuation is something that is not in favor. Now, the latest development is that, 2 proxy advisory firms, both SES as well as in-government, have gone ahead and recommended to vote for the delisting resolution to be passed. They've given their rationale. In-government says that, the amalgamation offers compelling revenue as well as cost synergies, in case it does go through. They're also saying that the combined entity will combine wealth management, broking, as well as banking services. SCS says that, the merger itself is not possible because the RBI regulations do not allow ICICI Bank and a broking arm to actually go ahead and merge with themselves. But they're saying that the delisting, if it goes through, will give shareholders access to larger and more diversified business stream with greater stability as far as revenue is concerned. What is the proposed scheme? Just to go ahead and look at it once more, especially in terms of how the merger ratio and the current market price is playing out. 67 shares in ICICI Bank will fetch 100 shares in ICICI Securities. At the current market price, the valuation discount has now narrowed quite significantly. ICICI Securities at this merger ratio is trading just at a 1.5% premium to ICICI Bank.
All right. Vivek, thanks very much for that important story. We'll get Siddharth's view on this in just a bit from now. But we'll do that after we take a quick commercial break here. So Sid is going to be with us, but Mitesh and Shrikant Chauhan are also going to be joining in with some technical trading ideas. Stay tuned. That's coming up. Welcome back. There's 10 minutes to go for the pre-open session. Mitesh is with us and so is Srikanth to run us through how they would trade this market. Gentlemen, good morning. Good to have both of you here. Mitesh, you've been advocating caution, and I think even despite the bounce that we saw yesterday, you're kind of, I think, expecting lower levels still, a slight drift down. How are things set up and what would you do, your trades?
Yeah. So Prashant, I've been actually maintaining some kind of a negative bias, and yesterday we had a very strong pullback to that. Now, the maximum upside which I thought the pullback could do was possibly around levels of 22,250, and we actually got to about 22,200, which I thought was a difficult thing. But yeah, I mean, there can be situations when bull market pullbacks are slightly on the stronger side. So I think that's something which has played out. Having said that, my belief is that today we might have a gap down opening with the GIFT Nifty trading in negative, and I would look at now 21,950 as, which is what I have highlighted earlier as well as the first level to watch. We might go there. In case you break that, then 21,800, 830 zones could be tested. So maintaining a negative bias, the idea is that if you get an intraday rally close to 22,200, go short there with a 60-70 point stop loss, or maintain your put options long position, which is what we have. Disclaimer, I personally have called short positions and put long positions as well, recommended to our clients, so there is vested interest.
Okay, well, Srikanth Chauhan is also joining in. Srikanth, hi, good morning. How are you feeling about the market now, considering that, things were all over the place on Wednesday, but yesterday there was some semblance of sanity. What is the view for today?
Good morning, Sonia. Good morning, Prashant. Yeah, I think yesterday we saw a very strong pullback, but it clearly failed to cross the level of 22,200, which is going to act as trend decider level for next few days. So unless and until the market is not crossing these levels, we are going to see some selling pressure in the market. And for the day specifically, 21,900 is going to act as important, crucial support for the market. Below that, we can expect weakness up to 21,700 with a minor support at 21,800. So broadly, breaking 21,900 will be negative for the market. That's the overall view. And for the Bank Nifty, there also we saw a good amount of profit taking. Below 46,900, the Bank Nifty can fall to the next levels of 46,500 or maybe 300. So at any rebound from current levels, it will be an opportunity for taking some profit on long positions or to reduce weak long positions.
Okay, what about individual stocks, Srikanth? What are your thoughts and what's your list looking like?
Yeah, I think as the markets are still above the levels of 21,900, we can take some mixed strategy in the market. I think ONGC looks good, which is around 263, 264. There is momentum. The stock was up yesterday. And from here, the stock can again move back to the levels of 275. So at current levels, ONGC is a buy with a stop loss close to 258. And on the shorting side, I think we should look for taking some bets on bank stocks because there was some profit taking and we can expect further more weakness. So Axis Bank looks weak. Axis Bank is currently around 1,080, 1,085, and from here the stock can, 1,060, 65, and stock can fall to the levels of 1,030, 1,025. So at current levels, Axis Bank is a short with a stop loss at 1,085.
Mitesh, what about your individual trades?
I have a mix of buys and sells. On the buying side, I'm only comfortable taking long positions on the IT stocks. So I have Wipro as a buy with a stop at 508, targets of 535 can be looked at. HCL Tech is a buy with a stop at 1659 for targets of 1720. And on the shorting side is Ashok Leyland. Keep a stop at 170, look for targets of 150. Adani Ports, I think, close around 1260, 63 mark thereabouts, and 1260, 55 is the support area. So if it starts trading below 1254, take a short with a stop at 1276 for targets of 1205.
Okay. All right. Gentlemen, we'll leave it there for now and get back for 9-10 calls a little later from now. Thanks very much for joining us. Sid is still with us. Sid, in this fall that we've seen, yesterday we saw a decent bounce. Have you guys sort of come out with the list of sort of your top conviction ideas where prices have fallen more than warranted? I mean, just based on the price correction we've seen, where you have coverage. I mean, any names you can suggest?
Yeah, so Prashant, while the correction has been more in the broader market and we have been suggesting a lot of focus to shift towards large caps, but we definitely have been looking at some of the stocks which we like among the list. If you look at, especially from the broader market, something like a PNB from the PSU banking space that we have been liking for a while now. And has seen a correction. BL from the defense space. Zomato is something that we have been liking from the new age digital as well as your e-commerce space, and may not have corrected that much, but that is something again that we are liking. So these are some of the names that we like. Also, if you look at some of the other mid caps that we have been consistently liking, Varun Beverages is another name that comes up in our top recommended list. Every time we see the market being volatile, the company has seen a strong journey of growth as well as in the recent strategic advances where the company has gone global with some of its acquisitions. We believe that the growth momentum for a company like Varun Beverages would continue. We are expecting a revenue growth of upwards of 20% in terms of revenue, and in terms of net profit about 28% over the next 2-3 years. And despite the higher valuations, we believe that the company could continue to do well on back of the newly launched products, increased penetration of the newer territories in India as well as in Africa, and expansion in capacities and distribution reach. So overall, we like the stock. Varun Beverages, we have a target of 1600. And we believe that could be a kind of a consistent compounder kind of a stock in this market.
All right, let's do one thing. Let's take a quick break. Siddharth, stay on. We'll come back to you. We'll also have the pre-opening rates and we'll discuss that big move that we've seen in OMCs with the fuel price cut. Prabal Sen of ICICI Securities will put focus on OMCs. Remember, the government cut fuel prices by 2 rupees a litre. What will the impact be? Stay tuned for more on that. All right, we're getting set for a brand new day. We have about 20 seconds left for the pre-opening rates to kick in. Let's find out what the momentumizer stock of the day is. Mangalam is here with more on that. Mangalam, over to you.
The momentumizer stock is Colgate. Why is that? Because in an otherwise wobbly market is a stock that hit a record high in yesterday's trading session. In fact, this week itself, it's up 4%. This month, it's up 6%. And if you compare the price move of Colgate to the Nifty as well as the FMCG index over the last 12 months, you'd see it's an outperformer, up 79% in the last 12 months. And this compares to the Nifty move of just 31% and the FMCG index, which has moved about 22% itself. Yesterday's up move was also laced with a lot of volume. So 2.7 times 10-day average volumes were traded on Colgate yesterday. And even the delivery volumes yesterday were close to around 3.16 lakh, which is roughly 4 times the average delivery volume that we've seen on every day of this month itself. What are the key triggers for Colgate, apart from demand recovery or looking at some sort of volume growth coming by for the industry? Revenue from a lot of the new launches that the company has done, a lot of them in the premium space as well. And as a result of all of this, they may grow faster than the market and gain market share as well. But remember, the name of the company is Colgate-Palmolive, so the Palmolive portfolio also is likely to grow 2 times the overall Colgate portfolio, and that's something that the management has guided for earlier as well. For all of this, fundamentally trading at a valuation of 50 times, not particularly cheap, in line with all the other FMCG peers, but definitely at a record high with a lot of momentum.
All right, Mangalam in momentum today. Thanks so much for joining in and filling in with that momentumizer. But let's focus on the mutual funds. Well, they have started releasing results of SEBI's stress test, with the industry-wide disclosures likely to come in by the end of the day. Surabhi joins us to fill us in with more details. Well, Surabhi, the markets were under a lot of stress waiting for these results. As of what we have seen, they don't seem bad at all. Go ahead.
Okay, well, Nigel, I'll just say that it's still early. We only had a couple of the AMCs that had reported by last night. A lot more will start coming in today. And by the end of the day is when we'll have a better picture, when the industry body AMFI will come out with a collated table with all. So I just, quickly want to run through the ones that we have. What is basically being tested? the number of days it will take any mutual fund scheme, mid-cap or small-cap, to liquidate their portfolio in times of big market stress when there is a lot of there is a huge exit or a rush towards the exit. So let's come to the numbers. If we talk about mid-cap funds, then the numbers will be on your screen. For Edelweiss, the time it will take to liquidate 25% of the portfolio for the mid-cap fund is 1 day, 2 days for 50% liquidation. For Aditya Birla, again, it's 2 days for 25%, 4 days for liquidating 50% of the portfolio. Sundaram is again 2 days for 25%, 4 days for 50%. You'll notice one thing as we move on to larger sizes. Look at the Axis mid-cap fund, for instance. Now, here it's going to take 6 days to liquidate 25% of the portfolio and 12 days to liquidate 50% of the portfolio. So keeping the AUM in mind is very, very important. Though I must say that there is no linear correlation. It's not always that a larger fund will take more time to liquidate its portfolio. Case in point being Sundaram. Check out the numbers for Sundaram, where the AUM size is over 10,000 crores. However, Sundaram can manage to liquidate 25% in 2 days and 50% in just 4 days, which is better than some of the others. Let's move to small caps, because this was a category under great scrutiny. Now, once again, if you look at Edelweiss, it's 2 days and 3 days, depending on 25% or 50%. Motilal, again, it's 2 days for the 25% and 3 days for 50%. Sundaram is 3 days and 5 days. Again, where the sizes are becoming bigger, and that's only logical, right? Larger the fund size, perhaps the more time it will take to liquidate the portfolio. And that thesis holds true for both Axis and Quant. Quant's fund size is 17,200 odd crores. So 11 days to liquidate 25% of the portfolio and 22 days to liquidate the Quant small cap fund. Likewise, Axis, 14 days to liquidate 25% of the portfolio and 28 days, that's nearly 1 month, to liquidate 50% of the small cap fund for Axis. Now, what is basically SEBI trying to do, or AMFI trying to do by giving this data, so that investors have a little more oversight about the liquidity risk that they must bear in mind. Along with this, there are other disclosures as well. Very quickly to wrap it up, now these disclosures will include standard deviation for the portfolio, beta, valuation measures like trailing 12 months PE for the portfolio, and concentration. Top 10 investors, how much do they hold in the fund? That concentration number is also going to be very crucial to watch.
All right, thanks a lot, Surbi, for that. So those are the stress test results, but giving a lot of people a lot of stress till the end of the day, till the numbers came out. But in any case, now we have more clarity there. But oil marketing companies have cut petrol and diesel prices by 2 rupees a litre, even as crude prices rise. So this is, of course, a negative for the oil marketing companies. There will be a margin hit. But to discuss the impact on this, we have Probal Sen, the energy analyst at ICICI Securities. Probal, hi, good morning. Can you tell us, in your assessment, now that you've had some time to digest this data, what will the impact be on the margins? And does this change the narrative for the longer term, business outlook for these companies? Because that seems to be on a steady wicket.
Yeah, so 2 things. In fact, I think the way we look at it is that it at least removes a overhang that has been there for the last several months in terms of when will the price cut actually come, what will be the extent of it, whether, it will be actually damaging to the profitability of the companies in a major way. So to that extent, our sense is that, the 2 rupee price cut is actually fairly reasonable, given that in the 9 months on a blended basis, almost 4 rupees a litre is being made in the retail fuel margin. So to that extent, even with a hit of around 1.6 odd rupees per litre on the margins of a 2 rupee price cut, the blended margins remain at somewhere around 2.5 to 2.7 rupees, which is what most of the street has been building in for FY25 and 26 in any case. So from an earnings standpoint, actually, the impact is not as material as one would think, which is, I think, a positive in the sense that the price cut is way more reasonable, given the fact that they have investment requirements, given the fact that LPG prices have also been cut, which have to be absorbed by the OMCs maybe over FY25. So to that extent, we would say that the overhang gets removed. One should expect a little bit of negative reaction without a doubt, specifically on companies with dominance of marketing, say like HPCL. But I would look at this opportunity to sort of enter the stock and build positions, because we believe that the business case doesn't get hampered as a result of these price cuts.
All right, Prabal. Hi, good morning. Good to see you. And for the time being, though, the stocks have opened up in the red, but you believe that, the price cut is pretty much in line and it's reasonable as well. So you'll be looking this dip to buy into the stocks, right?
Yeah, I think there are two elements to it. One is that is this price cut sort of a harbinger of further cuts to come, or is it something that basically restarts the normalization of pricing? And in that case, as and when the elections conclude and pricing gets back to normal levels, we see no reason to assume that if crude prices and product prices rise, the OMCs cannot recover those pricing hits eventually over from second quarter of FY25 onwards. So to that extent, as I mentioned, when the event happens, the price cut has happened. Yes, it's a hit on margin. So we definitely do expect a little bit of negative reaction. I think 2 to 3%, the stocks are down. And I would say that, that's probably reasonable to sort of look at. But as I said, if we look at from a 12 to 18 month perspective, the fundamentals of the businesses from the refining standpoint, plus in terms of, the operational improvements that the OMCs have done, specifically HPCL with respect to its refining portfolio, we would remain fairly positive on the name at these levels.
HPCL is the one, the pick among the three of them that are listed. Prabal, this 2 rupees cut you're taking in your stride, the fear is if there are more cuts, what kind of headroom you have in your estimates, that things don't get changed too much. As you said, with this 2 rupee cut, still your estimates for FY25 are in line. So in case there are more cuts, what kind of headroom have you kept? The breathing space, a rupee, 2 rupees, what is it?
So every rupee cut, on our estimates, if we look at it, another, where we are anyways building in about just about 2 rupees of blended net retail margins for petrol and diesel for FY25. So on those numbers, if there is a further 1 rupee cut that comes, or if the margins go down by every rupee, that has about a 12 to 14% impact on the EPS. But remember that if the fuel, if the marketing margins are actually cut by 1 rupee because of, let's say, higher international prices which may not be passed through, GRMs will also improve to a certain extent, which can help offset the cut. But that's the kind of sensitivity that is there, and that's the kind of vulnerability that is there, perhaps, in terms of our earnings. But we should note that our earnings are about 20% higher than what the street is at about 104 rupees on a consol basis for FY25, specifically for HPCL. So we would think that on street estimates, there is not much downside risk, which is anyways at about 82 rupees, if my numbers are correct. On consensus. So, I think to that extent, there is enough leeway for a little bit of margin softness in the first half for 25.
Prabal, I'll just read this out and just a slightly reading out a note which plays the devil's advocate here. It says, and I quote, with margin on diesel now below fair levels, this cut challenges the optimistic narrative of the government, allowing margins to settle well above the long-term average. So therefore this cut may be a big derating event. This is a note from CLSA this morning. They say that any further rise in oil prices would be an added worry for these stocks. Would you how would you read this viewpoint rather than this note?
Yeah, it would not be appropriate for me to comment on a fellow analyst's views. Those are his views. So I would leave it for him to, sort of explain the, background and context.
But does it challenge the narrative?
Yeah, I mean, the fact is that, as I said, there is obviously a margin hit. I don't, the diesel margins actually going into negative territory are only because in the last 3 sessions in particular, crude has actually risen up by about $3. Yes. And international diesel prices have also risen up suddenly on a spiked up. So I would hesitate to make a view on sustainability or otherwise of margins based on a 3 to 4 day movement for the whole of FY25. That's number one. Secondly, one has to look at the blended margin picture, given that gasoline continues to be in fairly positive territory despite these price cuts. So on a blended basis, they are still making an EBITDA, as I said, on retail fuel of around 1.5 to 1.7 rupees, which is broadly in line or maybe marginally lower than what, the street estimates are for 25. So to that extent, I would say that, sorry, go ahead.
No, over the last many months, we've seen earnings upgrades for oil marketing companies for FY24. Is there a case for earnings upgrades if oil stays well behaved around 80, 85 for FY25 from here?
I think
where earnings estimates are?
I think people will probably wait for the elections to be concluded and then look at how fuel pricing basically plays out for, reasonable visibility on what FY25 earnings are like. As of now, I think most people, are building in fairly, moderate GRMs as well as moderate to low marketing margins. My sense is that the street will stick to that. Again, I cannot speak for the rest of, the analyst community, but we would probably wait for another 3 months to take a definitive view on how FY25 shapes up, and how fuel pricing shapes up from here. As of now, we are comfortable building in a number which is about 20% higher than the street. So we'll probably stick to that for HPCL as of now.
All right, we'll leave it at that. Prabal, thanks a lot for giving us your thoughts on what this would mean for the oil marketing companies. Let's get back to the market, which looks like it's going to take a turn for the worse this morning. The Nifty is down about 80 odd points. Let's get our technical guest back on board. Mitesh is back with us. Mitesh, doesn't look like it's going to be a pretty start. I mean, there is an 80-point knockdown that we're staring at. What's the call at 9:10?
I think, as I said, a test of 21,950 would be the key here. In case we start breaking below that, then I think we'll look for more declines. And the call for the day could be sell on a show clearance. Keep a stop at 170. Look for targets around 150.
Okay, thanks a lot for that. Well, let's go across to Ritu now to talk about Paytm this morning. Ritu, over to you.
Well, NPCI has granted the Paytm parent entity 197 Communications approval to participate in UPI as a third-party payment application provider under a multi-bank model just ahead of today's deadline for the bank to wind down its activities. Now, there are 4 banks that are going to act as payment service providers: Axis Bank, Yes Bank, HDFC Bank and SBI. Between them, they will handle the UPI volumes. They'll, of course, be earning a fee for facilitating settlements and get access to a float that will be available in these accounts and the bigger access to merchants, of course. Separately, NPCI has said that Yes Bank is going to be acting as the merchant acquiring bank for both existing and new UPI merchants for 197. Now, if you recall, Paytm had said that about 20% of its total 4 crore merchant base has accounts only with Paytm Payment Bank. So these will have to get shifted to Yes Bank. And of course, any new merchants that they acquire, Yes Bank will be the bank for them. So in a way, Yes Bank is the key beneficiary from this action from RBI against Paytm Payment Bank because it gets access to this merchant base that it can cross-sell financial products to. For Paytm, of course, some churn is expected in the merchant customer base. Customer retention is going to be very important to watch out for. Morgan Stanley says they will watch out for updated commercials as Paytm Payments Bank's business moves to other banks. UBS says its base case is a 15 to 20% churn in the merchant and customer base, along with some loss in GMV. It expects Paytm share in digital payments to come down to 17% in FY25, expects a decline in loan disbursements to 2% and in revenues as well. And similarly, Jefferies is expecting an 88 to 15% hit to payment value and app usage.
Absolutely. And it's up 5%. I mean, so the high, I think, on Paytm was about 500 and it came off all the way to about 350. Today it's a 5%. That's a daily move, basically, the daily filter. The start is there, 22,070 is where the Nifty is at. The sensex is at about 72,822. So, these are opening first rates coming through. Oil marketing companies, perhaps, first off the block, which should be in focus, along with a few others. BPCL is starting about 4% lower. HP is down about 5.5%. HP, of course, as Sonal was also pointing out, perhaps hit the most. IOC is down about 3.5%. Oil India is higher. Advanced decline is okay, too early to look at it in any case. Bank Nifty, though, is like yesterday. Bank Nifty was the underperformer. It is down about 0.25%. But Sonia is on the wall with more rates. Sonia.
Okay, so since you started off with, the Nifty Bank and the pressure we're seeing there, also take a look at the Nifty 50, which is now just hanging on to the 22,000 mark by the skin of its teeth. Oil marketing companies, right? You pointed that out, so I just want to get straight to that. All 3 oil marketing companies are down anywhere between 2 to 3 odd % as the government has cut petrol and diesel prices by 2 rupees a litre. So this is definitely sentiment negative and there could be more pain in store on the margin front. Paytm, that one is reacting to positive news flow. The NPCI has now approved Paytm to participate in the UPI as a third-party application provider. So that, approval is a big positive for Paytm, for 5% higher over there. NHPC is in focus. In fact, both NHPC and JSW Energy have received a letter of interest from the Gujarat Urja Vikas Nigam Limited. For NHPC, it's for a 200 megawatt capacity solar power project, and for JSW Energy, it is for a 300 megawatt solar power project. So just keep an eye out on these 2 stocks. In fact, talking about order wins, BEL is in focus as the company has won an order worth 1,940 odd crores. The stock is up Okay, the stock is flat actually with a bit of a negative bias. L&T Tech has bagged a cyber security order worth 800 crores from the Maharashtra State Cyber Department. I'm also looking at some of the technology stocks this morning because there is a report from CLSA where they have reiterated their cautious stance on the IT space. They have a sell rating on Wipro, on HCL Techs. All of these stocks are a tad bit under pressure. Nothing alarming there. LTI Mindtree as well. Wipro, HCL Tech, TCS and LTI Mindtree. This is the cautious stance that they have on these stocks. Axis Bank also on my radar this morning as Nomura has put out a report. They have a buy call with a target price of 1250 on Axis Bank. But otherwise, the market opening is not as bad as what we saw on Wednesday. But anyway, the Nifty is still down about 50 odd points, hanging on to the 22,000 mark. Back to you.
Well, thanks a lot for that, Sonia. Well, keep an eye out on the broader markets. We had Mr. Sandeep Tandem earlier today of Quant Mutual Fund, and we had asked him about Swan Energy. He didn't answer that question particularly, but there have been investors out there, and he said he's positive on the theme on the whole. That stock took a sharp knock. In the last 5 days, it's down close to 25%. Today, it's bounced up close to 7%, and it's one of the top volume traded stocks. So keep an eye out on that one. You have the other one, Paisalo Digital, which is up close to around 8%. So that's popped up in style in today's trading session. Railtel, that stock is up close to 6.5%. When we saw a bit of a correction, that stock got hit hard. Last couple of sessions, it's pulled back a considerable bit. Capacite Infra, stock up close to around 6%. So that's coming out of one of the top volume buzzers. Let's pull in a few more. RK Swami, the recent listing, had a subdued listing. That's up close to around 6% as we speak. So that's a fair bit of stocks that are moving around. And I think Shakti Pump's very low volumes out there. But you have Gopal Snacks. It had a subdued listing yesterday. It was down close to around 5% by the time we wound up. It opened up with a cut of close to around 10%, Gopal Snacks. But that stock as well has bounced up close to around 5%. You have Quant Mutual Fund. That was one of the buyers in yesterday's trading session. Prashant.
Well, so it's a 50-odd point lower start on the sort of Nifty, and the Bank Nifty is absolutely flat. It's got a 40-odd point change, so nothing at all. And I think the small cap index and the mid cap indices is positive. The small cap index is up 0.5%, and you've got the mid cap index, which I think is also starting up about 0.4% or so. So broader markets, I think that's what matters, because the problem has not been in the large caps at all. It's been with broader markets, and there the recovery continues, at least in the word go. Small cap index is adding a little bit more in terms of gains. Just a few more names. So the PSU and railway stocks all bounced sharply yesterday. That continues, right? IRFC once again figures as one of the top volume gainers, 3.5 higher. Railtel is up about 7.5%. Exicom, which is the recent listing, was up 20% yesterday. It's up 9% this morning, and huge volumes. IRB did very well yesterday, 4% on IRB. Campus Shoes, that is 5% in the green, 231. KPIT Tech, I think we mentioned, 3% gains. Phoenix Limited, that's the mall operator, 2.5 higher, 2,700 on that one. Gopal Snacks, we just outlined, 4.5 in the green. Capacite Infra, that is up 9%, 250 on that one, so strong gains coming through. Lodha is up about 3.75%, and that is coming through with significantly strong performance as well. On the downside, there is not very much. Suzlon is down 1.5. Electra is down about 2.75. Electra is coming up with a very large volumes as well. So that is the sort of odd one out. But the top three volume-led losers are all oil marketing companies, which are down between 2.5 to about 3.5%. So that's the overall picture. Markets down about 70 odd points on the Nifty. Our market master of the day is Vetri Subramaniam. He's Chief Investment Officer, UTI Asset Management Company. Vetri, great to have you with us here as always. Good morning. Prashant this side. We're speaking out of the last few days where we saw a fair bit of volatility, unusual in the recent, as far as the recent history is concerned. I should say not used to, because we're used to very trending up markets. So a stark and, in a way, timely reminder that markets don't just go one way. How would you read the overall situation, Vetri, now with this shakeout we've seen in the broader markets?
Well,
a good thing about the way we work as mutual fund managers is we don't have to react to what happens to the market every day. But certainly, I would say, right through, I would say somewhere around December through Feb, the markets were pretty much on steroids. I think there's a little bit of a lull now coming in. And that's a good thing, because otherwise the valuations were starting to get very punchy. And that does, create its own challenges for investing. But I think, might be a little bit of the fluff is getting taken out now. And, hopefully things will look slightly more stable. As you rightly said, Prashant, I would actually strongly suggest to investors that they should be guided by past history of volatility in the markets. Drawdowns of 10% once a year are very common. Drawdowns of 15 to 20% are very common once every 3 years. And drawdowns larger than that are common once every 5 to 10 years. So as much as we've got this wonderful, pipeline of SIPs coming through from investors, and, many of them are investing for the very long term, this is not the kind of volatility that should start to scare you. This is very much par for the course. And that's the main message I would want to convey to investors.
Okay, that is a very important message to pass on, right, Vetri? Because you and I have both seen so many of these market cycles where such volatility is not just par for the course, it's actually quite healthy to get the froth out of the system and to make the market light again. I wanted your thoughts on how retail investors should approach it from here on. Do you continue your SIPs? Do you continue staying, sort of invested in equities, or do you move to other asset classes? Because there's a lot of money being made in asset classes like gold, cryptocurrencies, even real estate for that matter. Your thoughts?
Sorry, I think, thanks for asking that question. I think it's always useful to remember that eventually there's a whole bouquet of assets that you can choose from. And it is appropriate for investors to, first of all, have an asset allocation framework. And when we say asset allocation framework, it does not mean positioning yourself in the asset class that will do best over the next 1 year. It's the set of asset classes which over a 10 to 20 year period will help you achieve your financial goal. So please do not understand asset allocation as being, I'm going to pick the asset class that will do best over the next 1 year. You're setting yourself up for disappointment. I've been here for 30 years and I haven't seen anybody figure out what will be the best asset class on a rolling basis, on an annual basis. So it's really about staying the course and having that diversification across asset classes. The main point that I would, sort of build on what you said is that the market does provide you an opportunity every now and then to rebalance your portfolio, right? So maybe when you did your asset allocation framework in line with your financial goals, maybe you had, just for argument's sake, a 60% equity allocation. Now, because of the market movement, you could be higher than 60%, you could be lower than 60%. The way to think about it is that at some defined frequency, or when your allocation moves very significantly away from the baseline, you rebalance to the baseline. So it's a combination of having asset allocation and rebalancing at some frequency, which I think is the key to being able to sleep well at night despite volatility. And believe me, that's the biggest challenge that I find investors experience.
I've put it so beautifully. Vetri, thanks a lot for joining in, and good to hear those comments as well. Well, Vetri, I wanted to ask you about the financial sector, particularly in the backdrop of the regulatory action that we've seen from RBI on select NBFCs, whether it's gold, whether it's on lending as well, and unsecured lending in particular. How would you view this? What's your take?
Sure, Nigel. Well, I think it's good that the regulators are sort of being preemptive. They're being active and not reactive in terms of taking some of these decisions. The central bank's job is always to sort of make sure that things don't get out of hand, because remember, financial stability is a very important criterion for the central bank and for the economy to be able to achieve its medium to longer term growth objectives. So I see this literally as the central bank doing what it needs to do. Look for pockets where it thinks something has gone out of line. Look for areas where they have a very elaborate process of annual inspection of all sorts of lenders. And then when they see some patterns over there, maybe they are responding to that and they are starting to preempt. I will, however, say that when I look at the more longer term data, right, and I prefer to go back to pre-pandemic period. If I look at the pre-pandemic period to today, credit has grown slightly faster than GDP, nominal GDP over that period, but nothing which really raises any red flags, so to speak. I think looking at credit growth for the current year relative to nominal GDP makes it look like, oh my God, credit's growing so much faster than nominal GDP. But I would suggest, the last 3 years, the year-on-year numbers are all over the place. It's best to go back to, the quarter ended March 20 and look at it from there. And when I look at that pattern of credit growth versus GDP, I don't see anything systemic which is showing up, but the RBI has better access to data and they are perhaps acting where they thought it necessary.
Vesri, how does I know this is sort of slightly over the next couple of months, and markets, of course, will look beyond these events come and go, but we're into elections now, right? Election season, proper election season. What's the kind of roadmap you'd kind of expect because of how well the market's broadly done? Do you think, and especially the PSU space, we get so many questions going into elections. What is the, how do last couple of elections, how did PSU as a basket do, especially in this government where there's been so much improvement operationally and otherwise? Just your thoughts, markets into election cycle and PSUs as a space.
Prashant, that's a really difficult question. First of all, it's very hard to figure out how markets will respond to elections. I've been, watching elections actively as an investor in the market going back all the way to 1996. And believe me, every time the market surprises you for two reasons. One, sometimes the election outcome itself is a bit of a surprise. And secondly, sometimes the market reaction on the day of the outcome and what it does 6 months later is diametrically opposite. Right. So my simple advice to investors is don't focus on these events and the outcomes. And I think this time, certainly, looking at all the data, you guys put out a massive opinion poll, right? It all suggests that, the outcome is not going to be so much of a surprise. It could be the seat count, which is a bigger issue. So I don't think the elections per se this time are that sort of a destabilizer. Second part of your question as regards PSUs, I would just say that I have never liked to look at companies purely from just ownership perspective, right? I mean, I don't look at things saying I should buy all Tata companies or all Birla companies and so on and so forth. And therefore, neither do I look at it from the point of view of, just going on.
Oops, I think there's some issue with that video. It's frozen there. We'll get back to Vetri in a bit. But for now, the market is quiet, and I think quiet is good. The street would definitely like quiet, given what we've had in the last few days. The Nifty is just hanging on to 22,000, just catching its breath. A little bit of a pickup after the early morning fall that we've seen. The mid-caps actually in the green, which is a good thing. And you have a lot of support coming in from FMCG names. There's Britannia, there's Titan, even banking names. SBI is up in the green. And then, some of these metals which really got battered in the last few days are coming back. So JSW Steel is something that is looking good. But let's do one thing. Let us move on. We'll try and get back to Vetri in a bit. But for now, we'll also focus on some of the IT companies. LTI Mindtree is the stock on our radar. The company has entered into a joint venture with Saudi Arabia-based Global Digital Integrated Solutions, in which the company will invest almost $12.5 million for a 51% stake. To discuss more on this development, we have Sudhir Chaturvedi, the president and executive board member of LTI Mindtree, joining in. Sudhir, thanks a lot for joining us this morning and being a part of our discussion. First, on this particular agreement that you've signed, can you tell us a little bit about what is the rationale on this? What is the opportunity that you see for the company?
Sure. And good morning to you, and thank you for taking the time today. We are very pleased that Saudi Aramco, which is the world's largest oil company, selected LTI Mindtree to be its JV partner to set up this. What is a path-breaking JV for them, in terms of setting up a JV for IT services and digital solutions that to be provided initially starting with in KSA and then further on to the MENA region. Now, just in terms of market size, the KSA market size today is approximately about $14 billion, but it's growing very, very fast right now. It's the fastest growing technology market there. And the overall MENA market is about $60 billion. So we expect that this overall market by 2030 will be close to $140 billion and easily, as I said, the fastest growing market in the globe. And the rationale for this JV is to essentially bring the synergistic capabilities of the two companies. Aramco with its obviously it's the powerhouse in Saudi Arabia and extremely well known across the MENA region. So they will bring essentially their connects within the business community, and LTI Mindtree will bring its capabilities and its essentially its solutions and tooling to the JV. Just in terms of the amount that you mentioned, that's only for year one as we set up the business, but there is a plan to keep investing further in it because a key tenet of this is to create a local IT services company. So there will be significant presence in Saudi from a localization perspective. We will be setting up regional hubs in Riyadh, in Dammam, and in other places as well.
Got it.
So huge investment over the next 10 years from both sides to make sure that that we create the essentially the premier IT services company in the KSA.
Got it. And I understand the potential. I mean, Riyadh is the big hub right now as far as investments, global investments are concerned, ever since the opening up of the economy. So I get that. But just to understand, this is basically you're trying to increase your presence in the MENA region. How much does the MENA region contribute to revenue right now? What is the kind of growth that you're looking at from that region over the next couple of years for your own business?
So, I think at this point, the MENA region is part of our overall, essentially what we do across India and Asia Pacific, but what we are now doing with this JV is creating a specific entity that is focused purely on MENA. We've already had a very significant presence there. In fact, we've built on the back of the L&T Group. The L&T Group has a very strong presence especially in Saudi Arabia, and they've a very large order backlog, as you're probably aware of, in the region, as well as they've set up local offices, local factories. So what we're doing is we're building on the legacy that L&T Group has created to do the same thing from an IT services perspective. As I said, we already have quite a significant business with Aramco themselves, with the banks in the region, with insurance companies in the region. And now together we're looking to target the ministries and the giga projects. So projects like NEOM, Red Sea Global, there are various, there are at least 20 giga projects that are underway, and each of this will require very significant investment in technology. So that's the combination that we're going to bring together to start with, essentially with energy, BFSI, giga projects, and government ministries. We'll start with KSA and then expand to the MENA region.
All right. Hi, Sudhir. Good morning. Good to see you in. Nigel on this side. But could you give us a number as a percentage of your total revenue mix? How much does MENA contribute? And since it's growing at such a fast clip, where do you see it headed?
Well, we don't, disclose specific by geography, but what I can tell you is that, for us, the India and Middle East, the Middle East market has always been a very significant market. As I said, we built on the legacy of our, of our parent that has always been very strong in that region. I think we are probably, if not the largest, certainly among the top two in the region already. And those credentials were very important in terms of, us being chosen as this JV partner. Because I think what they wanted to see was commitment to the region. How much is someone willing to commit to the region in a way that we can jointly develop a completely new digital infrastructure for the country and then expand beyond it.
Okay, all right. So you're giving us more qualitative details rather than quantitative. So we'll stick to that. How's the quarter shaped up, though, for the company on the whole? Quarter three, I think you all had hinted that will be better than quarter four will be better than quarter three. Has it shaped up on those bases?
I think we said that, quarter four will be similar to quarter three is what we had said during our earnings call in Q3. I think we were continuing to see that. I mean, we continue to see caution in the environment. In fact, in all markets except perhaps the Middle East, where we are seeing, sort of easily more than double-digit growth in that region, and that's partly one of the reasons why we are investing so significantly there. I think one part, Nigel, that I'll add is to partners of ours like AWS, Microsoft with Azure, and then Google, all of these guys, SAP, Oracle, ServiceNow, they're extremely excited to see us making this kind of investment commitment to the market because they need a system integrator that they can work with on all these major programs. And we are the first mover here. And clearly, as I said, once you have a tie-up with Aramco and that to a JV, and this JV was blessed by both boards, right? So, imagine the Aramco board blessing the JV. So this is that significant. And I just want to make sure that, this was one of our key objectives in Q4 was to get this deal done. And we're very happy with that. In terms of the overall environment, I think, we're going to continue to see caution, but I do see some green shoots starting, but there is ways to go there.
Okay, Mr. Chaturvedi, hi, good morning. Just to zoom out a little bit, when that LTI Mindtree, the merger happened, LTI Mindtree, at that point, there was indication given that there could be the potential synergies worth about, I think, $1 billion and 200 to 400 basis points improvement in margins over the next 4 or 5 years. We are still early into that, right? I think just about 2 years in from when that kind of guidance was given, broad guidance was given. Are we kind of broadly still on track for that? Or do you think the environment perhaps has turned a little bit with discretionary spends, etc., looking uncertain, as you've highlighted during your quarterly meetings?
No, actually, yeah, you're right. I mean, in terms of, the plans that we have for the LTI Mindtree, the business case that we had for the merger, that is still, maintained. What we are seeing, in fact, I would say point out to 3 data points, right? If you see our order book, our order book continues to, grow significantly. We're now at around $1.5 billion a quarter in terms of order book, which is a good 25-30%, or in some cases 40% premium over our quarterly numbers. And the other aspect of that is that, we're actually being invited to a very significant number of large deals. So, which was the other merger thesis that, we'll get to play in a larger pond. And we've got just over $4 billion worth of large deals that we are currently bidding at. And the third thing was that partners, the large tech partners, the hyperscalers, the SaaS providers, the ERP companies they would see us in a different light with the scale that we had. And those 3 synergies have already materialized. Now, in terms of revenue growth and margin, yes, the impact of the market has been there. We've faced it as well, along with our peer group. But I think, as the market returns, because we've got some really strong fundamentals in terms of, as I said, order book and large deals. And the last but not the least, our customer satisfaction is extremely good. So post-merger, our first priority was to make sure that our clients saw no disruption at all. And that's something we've achieved really, really well. So in fact, our recent CSAT dipsticks show that clients are extremely happy with the way the merger has been executed internally because they've not seen any disruption. And frankly, that is step 1. And then, as I said, building on the rest of the merger thesis.
Just one other point. Is it maybe because of the environment, but also because your exposure to what we call discretionary spends is higher? Is that perhaps one reason why growth over the last, say, 4 quarters has been a little tepid? I mean, is there an additional point, and what can you do in terms of adding to your service offerings? Maybe greater sort of inroads into the ER&D space. Is there any change in direction that needs to happen, or you're well set? And it's just the turn in environment which will sort of help you. Yeah.
Yeah, I think what we have seen is, the discretionary spend has slowed down. That does impact projects in digital engineering, in e-commerce, in customer success. The kind of programs that were essentially designed to drive revenue growth have been, sort of the spend on that has reduced, and that has had an impact on us. Now, in terms of us, looking to make sure that, we've got a good balance between annuity revenue and project-based revenue, this is where the large deal footprint comes in, So amongst, I was talking about the $4 billion plus pipeline that we have in large deals. That's, about 80% of that pipeline is annuity revenue, which is cloud, infrastructure, security, applications, data. So these are the areas that we are already seeing a lot more traction in terms of large deals. So the book of business is already balancing in terms of, more longer term annuity deals. And we'll see the benefit of this in the coming years. But we want a good mix because, what we do want to do for clients is to not just save the money, but also to be able to make sure that, we leverage those savings for true digital transformation. Because, most clients in actually slowed digital transformation down. You cannot stop it. You have to continue with that process.
Got it. Mr. Chaturvedi, love to go on, but out of time. So thank you so much for joining us and taking us through that conversation. Good luck to you and hope to speak with you soon again. Thank you. We'll take a quick commercial break here. We are back. We've got a discussion lined up as far as the railways sector is concerned. So that's coming up in just a bit from now. Markets holding on. The markets turned and turned sharply. The indices will tell you that Nifty is down 115 points, but the broader market is where the turn has been even more significant. Small cap index is down 0.4 and the mid cap index is down almost 0.7%. So very sharp turn on the way down. Market breadth is now negative. 1,300 stocks are lower and you got about 1,000 stocks which are higher. So just a bit of a turn. Need to be watchful from here on. But let's get into that discussion as far as the railway sector is concerned, guys.
Oh, absolutely. So this is the railway sector that we're looking at, which has had a very, very strong run, right, in the last many weeks and months. But in the last few days, there's been a bit of a correction. How is the sector expected to perform in FY25? What's the order book outlook? What is the opportunity that railways companies can cash in on? We have Subodh Jain, who's the former member of the Railway Board Engineering, and E.B. Rao, the COO of Kernex Microsystems. Gentlemen, morning to both of you and thank you for joining us on the show. Mr. Rao, I want to start by asking you about what is the order book currently that Kernex Microsystem has. What is the demand environment now in the entire ecosystem and what do you see as the way forward?
At present, Kernex Microsystem have 600 crores order book and the projects are ongoing. And anticipated in short time, 6,000 kilometers train pollution avoidance system tenders upcoming. And there is a very good prospects for TCAS system because Railway Ministry decided to implement at the fastest rate possible.
So this 600 crore order book is for your company, right? For Kernex Microsystems?
Yes, it is Kernex Microsystem.
Okay, and when is the execution expected to be? I mean, how much will you execute in FY25? What would this mean for your revenue growth as well, if you can help us with that?
You see, this year now we have completed milestone 1 and we are expected to complete milestone 2 and this project has been divided into 4 milestones. Right, so we are in the completion of milestone 2. Within month's time it will be completed and project completion date is September 2024. We are planning to achieve those targets.
Okay, got that, sir. Well, let's get in Mr. Subodh Jain as well into the conversation. Hi, Mr. Jain. Good morning and thanks so much for joining in. If you could tell us what is the current total outstanding orders from the railways and give us a brief idea about the execution period as well.
The outstanding orders about which sector?
For the
locomotive.
Yeah, you could break it up for us, sir.
Say, if we see the locomotives are in 3 parts. The locomotive wagons and the Vande Bharat train sets. So, it's in the public domain. Vande Bharat train sets have been awarded 2 contracts. One to RVNL and Russian company JV and another to BHEL and Titagarh wagons. They have 24 months for the prototype approval. Time, I think about 15 months are still left. Other than that, Vande Bharat today are being manufactured at ICF, where electrics are being supplied by the Medha. So that Medha will continue. This order is, I think, some 400 coaches type. I will not guess. I don't have the exact figure right now with me. So whatever Vande Bharat we are seeing today, they are coming from ICF with the support of Medha. And the Vande Bharat which have been tendered, they are of a different specification the speed potential is more, and there are certain more advancements in those Vande Bharat. That we can see in the service maybe about 2 years down the line. So right now, the orders which have been placed, I don't see that it will survive unless somebody fails. It's okay for next 10 to 20 years. I don't think that there will be space for any new player.
Because so is it fair, sir, is it fair to assume that a lot of the orders now that will be given out will be mostly to the larger players? So basically the
orders are already given out. What was the planning for Vande Bharat for next 5 years, the introduction, those orders are already given out. Yeah.
Okay. Okay. What is the average size? And going forward, any of the new orders, can you tell us what is the average size of the new orders that will be given out? Will it be much higher than what we've seen previously?
For a thumb rule, a Vande Bharat train, 16 coach train is 160 crores. So 400 train sets was announced in the budget. Once prototype are approved, these two firms have been given order, they have to be given substantial orders to sustain the production. The RVNL will produce in the railway workshop in Maharashtra somewhere, and Titagarh wagon will produce in the BHEL facility and at Titagarh facility. So these are capital intensive works. You cannot, they are not off the shelf things that today you give order to X and tomorrow you give to Y. So once we have given orders to two companies, we have to give them time to develop themselves. I don't think that it will be right to bring in a new player unless one of the two fails.
Okay. All right, Mr. Jain, giving orders is fine. I want to understand whether the industry is equipped. Is there adequate capacities? And how long does it take to build further capacity since there's such a big scope of work in the next few years?
Yeah, that is a good comment. In fact, railways have been experimenting with these things. We brought in LHB, we brought in the AC locos, that modern locomotives. The method is very clear. First, we bring in where there is an import content of the order of 40 to 50%. And then as the market grows, as the Indian domestic industry responds, then the ancillaries are developed, and finally we achieve about 90% of indigenization. It takes about 15 to 20 years from the past experience. Future may be faster because now the government policies are such that we may do Make in India very fast, but still it will take about 7 to 8 years to bring in about 80% or 90% of indigenization. Certain import content will always remain in the rolling stock sector. So industry will respond. I don't think no reason that industry will not respond because these are high margin business and they are highly specialized manufacturing. But in the past, industry has responded. We are producing the LHB coaches now indigenously. They are almost 100% indigenous. And it is all domestic, all glass and composites and all, which we never thought that will be manufactured in India with so good a quality. But now we are almost international quality. In fact, the objective and dream is that we should be able to develop the industry so that we can export. That is why the capacity being ordered is much more than what domestic market can sustain.
Okay. All right. Mr. Jain and Mr. Rao, thank you so much for joining us and telling us about the railway sector and how things are shaping up right now. Well, moving on, we will also be talking about Biocon Biologics. Remember, the company has sold its Indian formulation business to Eris Life Sciences for 1,240 crores. We're joined by the MD and CEO of the company, Shrihas Tambe, to discuss the contours of the deal and more. Mr. Tambe, can you give us first the rationale, right? What is the reason for selling the India branded formulations business to Eris Life? Is the supply arrangement with Eris exclusive only for the Indian markets? And are there any restrictions you would have with such an arrangement with other branded formulation players in India?
Yeah, I think the first thing is that I would like to say that this is an excellent extension of our earlier relationship with Eris Life Sciences, which we announced in November of last year, where we are now further building on that strategic commercial collaboration with Eris Life Sciences. Now, what we are doing in this relationship, in this deal that we've just announced, is we are further expanding our reach to patients in India using the capabilities that we've seen with Eris Life Sciences commercial field force capabilities. Biocon Biologics will, of course, remain committed to this entire market, the patients, given that we will continue to manufacture and supply our high-quality biologics to patients in India. So I would look at this as a very complementary collaboration between two existing partners and building on a relationship that allows us to really deliver on that ambition of reaching 1 in 5 insulin-dependent diabetics in the country. And I think that is really what this has been about.
All right, but sir, can the supply arrangement be terminated or discontinued by either of the parties, or are they bound for 10 years?
Yeah, I think the important thing to look at in this thing is that there is it's not a restrictive arrangement. What we are looking at is more an enabling arrangement, an arrangement where we are looking to expand our commercial reach using the Eris Life Sciences strengths in commercialization. So it does not prevent us from working with others, but it's certainly these particular brands that we have commercialized, and you would have known Insugen and Basalog have become very familiar names in the Indian industry, particularly in the diabetes space. And these are both products which have more than 100 crores in revenues. These would be, of course, exclusive to Eris Life Sciences. So the current brands in the business that we've got would certainly be exclusive to Eris Life Sciences, which we want them to commercialize and bring it to the leading position that it deserves to be.
Got that. Has the company, with this stake sale, exited the entire India formulation branded business?
Yeah, again, I would like to clarify, we've not exited anything. In fact, we are further strengthening our position here. As I said, and we've announced it as well, that we continue to supply, manufacture, and we'll be committed to growing the Indian business along with using a commercialization partner like Eris Life Sciences. Now, of course, Eris Life Sciences will have the rights to commercialize these exceptional brands that we've built over the years. And you can see that the value that we've been able to monetize in the brands, which is 1,242 crores, reflects the huge potential that these brands and the business that we've built over the years has. So we're not looking to exit anything. We're very committed to India. We're very committed to patients here. And we will be looking to strengthen our presence along with Eris Life Sciences, who will essentially represent a far more and a far stronger commercial reach than we had, given that they have a bigger portfolio beyond just the biosimilars.
So what will the 1242 crore rupees be used for? Is it for debt reduction? What's the total debt on the books for Biocon Biologics? If you can help us with both the structured and the unstructured debt, and how does it change the balance sheet?
Yeah, at this point, the way I would look at this really is that we should view this as a more strategic collaboration, which has allowed us to monetize the value that we've created. And it allows us, more importantly, to invest in the business to go forward. Yes, we can discuss the net to EBITDA ratio. Clearly, it shows that there is a lot of potential in the business, because on a forward-going basis, it has certainly given us a lot of value. There is value that the buyer sees in this, which reflects what we've been saying all along. On a valuation perspective, it has given us 3.4 times the revenues that we reported for this segment in India and 18 times the EBITDA, which tells you that it's been a very strong potential that we've been able to realize for this business. And whether we use these proceeds just from one way to the other, I would focus more on seeing how can we use these, the monetization of this business to strategically grow the vision that we've set for ourselves in the years to come.
Well, could you please share details on that 10-year supply agreement? How much can Biocon basically make from it?
Yeah, I think that is a little speculative in nature, but I build on what we've been discussing, and Eris Life Sciences have probably said in the public domain already. Clearly, both partners have seen huge potential and huge opportunity in this. What we were looking at was the commercial reach. Both Insugen, Basalog, just to name a couple of brands that we've commercialized today, have over 10% market share. We believe that there is an opportunity for us to grow both these brands and the other products as well significantly. I would refrain from giving specifics, but there are numbers that Eris Life Sciences has indicated over the next 3 to 4 year horizon. And I would encourage you to look at that and be very supportive to see how we can grow this market in India.
Mr. Tambit, the US FDA has classified your Malaysia plant as OAI. What is the status of remediation there?
Yeah, so we've, in Malaysia, we continue to supply commercial products, particularly our insulin glargine to the United States. We have, of course, had approvals from all other authorities across the world, including the European authorities, which is EMA, and we continue to supply that. We do have, at this point in time, the OAI status there, and we are working with the FDA to see how we can navigate that and recategorize or reclassify that.
So what is the likely approval timelines for insulin aspart now, given the outstanding issues at the Malaysia facility? Do you expect any delays over there?
See, we've already responded with all the CAPA actions. We've put in place a very comprehensive CAPA plan. We have also engaged the services of reputed international third-party consultants, experts who've been in this space for several decades. And they've also provided a very positive report in terms of what we've done and how we've enacted since the observations. And that has also been submitted to the agency. I would like to reiterate, we are in conversation with the agency, and we are looking forward to moving this as quickly as we can. But it would be unfair to comment on behalf of the agency as to when we would be able to get to approval.
Well, there was a CRL issued in February 2023, I think, on cancer drug Avastin bevacizumab. Has the company replied to it? And is there any possible approval timeline?
Yeah, and if you've referred to our earnings call as well, I think the concern there has really been that we've not been able to get the agency to come over. I think the agency is looking to schedule the pre-approval inspection to our India location, to our Bangalore location. There is no outstanding information that we need to provide at this time for them to review. At this time, we've sent all the information that was required, and the agency will look to schedule this inspection. So unless that pre-approval inspection gets scheduled, which is a necessity from a regulatory perspective for all biosimilars and biologics drugs, we basically await their plan to come over and inspect us.
Okay, appreciate your thoughts. Thanks a lot for joining in. Let's take a quick break. On the other side, Mitesh Thakkar will join in for some technical trades. Stay with us. Welcome back. Well, the market is not looking good at all. The sensex is now down 400 points. The nifty is down 136 points. So once again, we're back to our losing ways as we've seen in the last few days. Mitesh Thakkar joins in for a quick tech check. Mitesh, do you think this could escalate further? Because it's not looking good. The mid-cap index is now down 1%.
Good morning again. I think eventually it will. What I'm not sure whether it will happen immediately, because 21,950 remains some kind of an important support pivot. If you look at the last 4 weeks of data, I think you will find that on an hourly closing basis, we tested that level multiple times and we bounced back from there. In fact, on Monday itself also we had an intraday low of 21,905, but the hourly closing was closer to about 21,965, 970, and then we had the bounce back yesterday. So I think, what we've done is taken marginal profits off the table. Let's say 25% of the shorts have been booked. But the sense that eventually I think we'll break below that. So the directional bias is on the negative side. On stock side as well, I have a sell on REC. That's a stock breaking below key support areas. So keep a stop at 458. Look for a target of 430 here. And also a sell on Bharat Forge, which is also turning negative on the short to medium term charts. Sell here with a stop just above day's high of 1125. Look for targets of 1060.
Mitesh, I wanted to review on a couple of stocks. One is HDFC Bank. We had mentioned at the start of the series that for the initial part, it will have support because of that rejig that will take place, which will get done by today. What's your view on the stock? HDFC Bank has popped up to around 1,450 and it's been fairly stable after underperforming. What are the levels you're looking at this one?
So, Nigel, I think, one, it's been stable because it had a big fall and then it's trying to consolidate. Now, I'm wanting to see if the stock has got strength to give a fire reversal, which, given the fact that the general market is turning weak, will be a slightly difficult task. But till it crosses and closes above 1470 on a daily basis, I think the immediate view is that it will be sideways. Only above 1470, once the closing happens, you can look at some kind of a short-term up move with higher targets of 1545, 1550 on the upside. Otherwise, it will do a range of about 1470 to about 1400.
The oil marketing stocks, right? I mean, HP was down almost 10%. It's down about 8.5% now. It'll come up on your screen. 461 is where HPCL is now trading at. So the pressure there is quite large. The other ones are, of course, also down. BP is down 5% and IOC is also down about 4% or so. So for now, I think the view from CLSA working out, I mean, at least this is the first hour and a half, they were a little more negative in terms of what this price cut means. Others have been more sanguine, saying, the cut is, markets will look through it as we kind of go along. HP is already recovering as well, so keep an eye. But the Election Commission has released the electoral bonds data shared by State Bank of India following the Supreme Court's directive. The data includes details about donors, their contributions, and the parties that redeemed these donations. Hormuz is here with some names. Hormuz, morning.
Morning, Prashant. And 98 donors there combined that the list have been shared by the Election Commission of India, and 23 of them accounting for more than half of those donations. So we filtered them down to parties that have donated more than 200 crores or more, and some big names in that list. I'll start off with some names that are the top two. Top two are some unknown entities there. One of which is Future Gaming and Hotel Services. That is the one that has the highest donations of over 1,368 crore rupees, combines to around 11% of the total amount donated. They are involved in the business of lottery and hospitality services based out of Coimbatore. That is the name that is coming up as the top highest donor in that list. The other name, the second one, is the interesting one, that is Megha Engineering and Infrastructure. And they have donated around 966 crore rupees, which is around 8% of the total donations. Now, its website says that it is the third most valued unlisted company in India as per the Hurun list that was released in February. We cross-checked that, and Hurun, it is part of the Hurun list with a value of around 67,500 crore rupees. And interestingly, it also is the promoter of Electra Green Tech. It has a 50% stake there in Electra Green Tech, and as we speak, Electra shares are also down 4%. The company is involved in the business of infrastructure, power, irrigation, and many other businesses, and it is based out of Telangana. So Megha Engineering and Infrastructure there. The other name emerging is Vedanta, 400 crores of donation there, 3.3% of the total amount. As we all know, metals mining is a conglomerate there. Vedanta, the Anil Agarwal led company, 400 crores donation there. The other name emerging, now some other big names there. Haldia Energy, which is a RP Sanjeev Goenka group company, that has donated around 377 crores or 3% of the total donation amount, and it is involved in the power business. So there another big company of another big conglomerate. SL Mining and Industries is the next one. Now that is an Aditya Birla group company, 1.8% of the total donation, 224 crores donated as of now. The company is involved, it is the largest iron ore mining company and producer of noble ferroalloys according to its website. SL Mining and Industries there. The other one, Western UP Power Transmission Company. Now that is a related entity of Mega Engineering and Infrastructure, as we just highlighted. So that has also purchased around bonds worth around 220 crore rupees. So the combined total there from Mega Engineering and Western UP comes up to around 1200 crores, and that is involved in the business of power transmissions, 1.8% of the total donations there. And lastly, Bharti Airtel, 198 crores of total donation and 1.6% of the total amount donated as well. So quite few big names, but two of the biggest donors are unknown entities. Back to you.
Okay, thanks a lot for that. Let's slip into a quick break. On the other side, we'll get chatting with Rajesh Prasad, the Senior Executive Director, CBRE, and Anuj Puri of Anurag Property Consultants to put focus on the Mumbai metropolitan region redevelopment, as reports suggest that Maharashtra government has cut the premium for redevelopment of cooperative housing societies. More on that coming up. Well, let's focus on the Mumbai metropolitan region redevelopment. News reports say that Maharashtra government has cut the premium for redevelopment of cooperative housing societies. To talk more on this and the real estate sector outlook, we're now joined by Rajesh Prasad, the Senior Executive Director at CBRE, and Anuj Puri, the Chairman at Anurag Property Consultants. Gentlemen, morning to both of you. Anuj, I want to start with you because, redevelopment in Mumbai is a huge opportunity, right? Some reports are indicating that there is a 30,000 crore opportunity that we're seeing in terms of the redevelopment size in the MMR region. Tell us a little bit about that, and what do you see as the potential over the next couple of years?
So first of all, a very good morning to you and your viewers. It is absolutely a phenomenal opportunity. Mumbai residential itself is 50% of the India's residential. So you can well imagine every year there is nearly 185 lakh crores of new homes that are sold. So the problem in Mumbai then comes out is, where is the land? How can we continue to grow the land if that is the kind of velocity of sale, and nearly 50% in terms of value of new residential being sold only just in the MMR region. So one of the things is the redevelopment that has come up, which the government has done a fantastic thing on the redevelopment. This is largely the old societies. Just for your viewers to understand, the old societies, which have been in place for 15, 20, 25 years. There is an additional FSI that you can build on it. The building is very old, and obviously there are no facilities in those buildings. So the Maharashtra government has given this option that you can redevelop the entire society and take advantage of the additional premiums to be able to go high rise. And, initially I was not very hopeful that the scheme will pick up. But what I have now seen is very good quality developers, whether it's Rustamji, Rahejas, Mahindras, number of these large developers, listed and unlisted, getting into this space, because this is a very profitable business for the developer, and yet at the same time really beneficial to the occupiers, because they give their old flat out and they're rehoused elsewhere by the developer, and then they get a much bigger, newer flat in exchange for old flat.
Got it. So that's how redevelopment works. We understand that, but you said it's much more profitable. Can you tell us the margins on these redevelopment projects? Are they much higher than the traditional projects?
Yes, they are much higher. The reason for that is because you're not paying for land. As a developer, you're not really paying for land. You are paying for the additional premium that you are buying, and you're spending the money on the cost of construction. And you're also spending the cost of construction for the existing occupier, on the homeowner, because the homeowner is not going to pay his share of the cost of construction. But if you look at overall, if you were to buy the land and build it up, the profit margins are between 20 to 25%. Here, the profit margins are between 25 to 35%.
Okay. All right. Gentlemen, morning, Anuj and Rajesh. Just a basic question, Rajesh, to get you into the discussion as well. You heard Anuj, of course, very bullish on this entire opportunity. And by the way, we've had listed companies like Mahindra Life Spaces come on the program over the last many months and actively talk about this opportunity. It's a full-fledged sort of initiative now to look for these redevelopment, societies, etc. in Mumbai. Rajesh, is there a minimum kind of threshold under these rules which have been specified? A number of years only after which a project, a development can be redeveloped, a society can be redeveloped? And are there any other operational issues, or this is now all streamlined and good to go? Your thoughts?
So, that step that you mentioned, which the government has taken, which was flashing on the screen right now, as Anuj also mentioned, it's a very positive step, because most of the stock that we're talking in residential going forward, I think the future is more on the redevelopment side, because Mumbai is geographically constrained with water on 3 sides. On minimum threshold, normally, I think we are talking about larger societies, which are like 25, so, it's generally we're talking about, 10 acres plus societies, and, the government is trying to see what more they can do at their end to try and bring in more supply, so that there's a fair bit of balance achieved with the demand, because, the demand is at an all-time high when we're seeing in residential. So yeah, there is a concerted effort which the government is putting in, and this latest step is definitely a step in the positive direction towards it.
Okay. You're saying that builders will not be, only beyond 10 acres it is viable for builders, or because, yeah.
See, the larger developers, when we talk about, like Anuj mentioned, right, we are seeing all the big boys get into the game. Or if you recall earlier when we used to talk about redevelopment, it was normally the mid-tier or the smaller developers that they were opting for redevelopment. But with now very limited development opportunities, right, we are seeing the big boys, the institutional developers, the developers from South, like Puravankara, Prestige, they are getting into the redevelopment game. And from whatever conversations we've had, there has to be a certain size and scale, for them from a management bandwidth and a financial wherewithal standpoint for them to get in, for it to be viable.
Okay. Anuj, comment on this, because we are talking about record high registrations in Mumbai every other day. But how much of it is coming from redevelopment? Because usually it's connected to higher demand in a particular market, but a lot of it is coming from redevelopment. What is that number?
So it is not that much at this moment in time, because this redevelopment really has picked up, I would say, in the last 18 odd months. It does take a long time before the project is available for sale, because the redevelopment mandate is signed between the developer and the society. But by the time the society vacates it and the building comes down, it's usually 12 to 18 months. It's unlike a clean, clear plot of land. So my thought is that you will see next financial year, the society redevelopment supply hitting the market. This financial year is minuscule that has hit the market, although a lot of deals have been done, but they were not vacant land parcels. And by the time, they've got vacated, it's taken that much time.
Okay. And how much is the new supply? Can you give us a sense of how big the redevelopment market would be right now in Mumbai, or the opportunity?
So I'll divide into 2 parts. On the redevelopment, one was the SRA, which was the slum rehabilitation. And, that scheme, we did not see any quality developer really go into it in a very large way. There were some quality developers which went in, but not really meaningfully. In this society redevelopment, we're genuinely seeing a number of these good quality developers, because a lot of these societies are actually South Mumbai based. So whilst I agree with what Rajesh said is 10 acres, but in many of these South Mumbai residential redevelopment societies, the land parcels are much smaller and the viability is very high. So if you were to look at the total value terms, my thought is that over the next few years, nearly 15 to 20% of your new supply will come from redevelopment of societies. And in terms of value, this may go up to 25%.
Okay, got it. Before we let both of you go, I wanted your thoughts on the other big news flow that came in the last couple of days, right, on fractional ownership of real estate, where SEBI also is now seeking to regulate and organize this entire piece, the fractional ownership piece. Anuj, your thoughts first on what kind of potential you see here, and is there enough transparency in the sector already?
So, fractional ownership was going on for some time. I think SEBI has done a great job that they allowed it first to go on for some time, and now they've come out with regulations. It is in a lot of demand by the smaller investors. So, if I'm a small investor, maybe ₹1 lakh I want to invest, I can't buy real estate. I can buy stocks of listed developers. I can buy REITs. But what else? This is where the fractional ownership is going to really impact. and it will attract smaller investors who do want to play in the real estate. So clearly a very nice direction. Had been in the business for some time. We were not getting into it because we wanted this to be regulated first, and we're delighted that now SEBI is come in. You will see institutional players now get into this frame.
Okay, so SEBI is coming, so now institutional players will get into this frame. Rajesh, I wanted your thoughts on it because there are some issues with fractional ownership, right? One is, of course, it's not regulated. The other one is it is illiquid if you compare it to REITs, and the investment is also high. There's a minimum ticket size that you have to pay of, I think, 10 lakhs. So do you think it will get enough traction despite SEBI, coming in and trying to increase transparency in the sector?
In fact, with SEBI coming in, I personally believe that there will be more traction because that will give a lot more comfort and confidence levels to investors, to go for it, because now it's regulated, right? And one of the biggest challenges that we've seen in fractional ownership is, as you said, when it comes to exit, right? The exit is very complicated, right? And that's where all the regulatory, bit and the governance, once it steps in, it will enhance the confidence levels, and you'll see more people opting for fractional ownership. As I said, the canvas of target audience is so much more larger when it comes to investing in real estate, if you're talking about fractional ownership.
Sorry, we're jumping topics here, but since we have both of you with us, Anuj, this entire, in Bangalore, right, recent headlines on water shortages, etc. From a property sector perspective, what does it mean? This has been one of the fastest growing real estate markets. Will we see, by the way, the city is now imposing water curbs, water usage, etc. So these are pretty, it's the reality, but these are also, of course, these could deter future home buyers and people who want to set up sort of businesses or take office space, etc. If this is the direction and the situation is not addressed immediately, what's your take on the matter? Yeah.
I 100% agree with what you're saying is, the real estate development will now get into serious sustainable development. I think for the longest time, we've been talking about sustainable development, but it has really been largely words. On the office side, it had picked up because the occupier wants sustainable development buildings. They want platinum rated buildings. So hence recycling of the water, etc. was done. But on the residential side, the home buyer is not sophisticated as yet to be able to ask. But is the situation, if it continues the same, going to impact real estate? 100% it will impact real estate over a period of time. So it will need to be addressed very quickly. Bangalore is a very attractive city, and you cannot have this problem, continuing, because it will deter a lot of the office occupiers, as a result of which the real estate market.
Okay, all right, gentlemen, thanks a lot for joining us and talking about some of these hot topics in the real estate space. By the way, it is curtains down on Bazaar, but don't lose sight of the markets looking very, very ominous at the moment. Below that 22,000 mark on the Nifty, it's getting worse by the minute. The sensex is now down 460 points. So we leave you with that screen where there's a lot of red. Chart busters coming up next. Stay tuned.